Hi guys, welcome back. In this fifth part of the market profile educational series, we are going to continue our emphasis on determining who's in control of the market, whether it is the other time frame buyer or seller. And this time we determine that by taking into account the opening of the market and where the value area placement is. So before wasting time, let's begin. This is one of the most important parts of market profile. So up to now, whatever concepts you have learned, you have to apply them in conjunction with what you see right now. All right. So let's begin. Okay. See. Value area, as I said before, is something where maximum trading activity for that profile is happening. Right now, when you see the placement of value area with, the opening of a particular profile with respect to the previous value area, then you get an instant hint about what is going on in the market. It is in the longer term profiles. It is important because even in short-term profiles it is important because it directly tells you whether the OTF trader is present in the market or not, and that is invaluable information. All right. So what you need to see is what is the relation between value area and price. By relation I mean whether the price is chasing the value or the value is chasing the price. When a price chases value, that mostly happens in bracketed markets. Bracketed market means range bound markets. But when a trending market develops, then the price runs away ahead and value eventually catches up with price. So we want to be in those kind of markets where value is chasing price rather than price chasing the value. Okay, because remember one thing, value area is such a thing that attracts price towards it always. So when you see a situation where the price is just running away from value, that means something different is going on in the market, and as traders we need to be in those situations. This is one of the key things that I do to buy options during my trading. I need to see whether value area is moving higher and chasing the price. Okay. Again, as it is valid for all the previous concepts discussed, the following concepts can be applied to both day trading and positional trading, whichever you're comfortable with. So basically we are going to study these value area relations. The first is the opening of the market happens within the previous value area, and when it is happening within previous value area, that means it is happening within the range also. Okay. The second is opening happening above the value area, previous value area, but inside the previous day's range. Okay. By range I mean high minus low of previous day. And the third kind of opening is opening outside range. So automatically when it is opening outside range, then that means automatically it's opening outside the previous value area. All right. So let us pick up these concepts one by one. So the first is open within the previous value area. Now what this means is that you have a previous well-defined value area and the market opens within that only. The first thing that we are studying is acceptance. What does acceptance means? Acceptance means that when the market opens within the previous value area, it is accepted there. Price rotations happen there. This indicates that nothing has changed from the previous profile or the previous day. Okay. So usually what these kind of markets signify is that the range of today's session will more or less be like the range of the previous session or profile. Alright. Now since we are seeing the opening within previous day's value area and the range, that means no major other time frame trader is present, hence the risk is small and the opportunity is also small. Alright. Because market is in balance. When will the market be out of balance? When it opens outside the value area. And when it will be extremely unbalanced, when it will open outside the value area and outside the range. Okay, I hope it's clear. So see, what happens here is This is the previous day profile, the previous value area. The price opens here. It opens here within the previous value area. It continues to rotate and it does nothing special. The range of this profile is roughly similar to this, although it's a little bit smaller, but I hope you're getting the broader picture. What happens here is that usually the profiles overlap to one side. So here the profile has overlapped on the downside, but it can also be possible that this profile cuts off here and it overlaps here, and that would be nearly of the same range as the previous profile. Now these are the kind of market where you want to be out of it. Now how do you know before it prints that we want to be out of it or into it? Now it's very easy to say, but how do you say in real time? One of the most important clues that you get is if within in the first 3-4 periods, that is, let's say if this is a 30 minutes, each letter has a 30-minute time frame, then the first 1 hour, 1.5 hours, if you see that nothing is happening, then you can be sure that this is the acceptance part of the opening within the previous value area concept. Now if you see one thing, this is the market has extended downwards, I think, in which profile? If this is the value area low, A, B, C, D, E, F, G, H. In H profile, the market has breached this previous value area low. That means sometime later in the day, some other time frame trader has come and extended the range downwards. Okay, it has happened in H profile because you can see A is still here. So the range till H profile was this much. So I mean, someone will look at this as normal variation. Yeah, it may be normal variation, but it can also be. It is normal variation on standalone basis, but when you look at it with respect to this profile, it's a non-trend day profile because nothing much has happened. But this clarity emerges at end of the day only. It's very difficult in real time, at least for those who are starting. All right. Okay. So next is opening within the previous value area, but this time rejection. See, last time we studied acceptance. This time it is rejection. What it means is that the market does open within the previous value area, but the market rejects that region, and multiple TPOs do not build in the previous value area, and the market just drives out of the previous value area within the first 30 minutes. It can also happen within first 60 minutes, so that's okay. Okay, so now see, when the market is opening within the previous value area, that means risk and opportunity both is low. But as soon as the price move beyond the previous value area, both risk and opportunity has changed. Hence the trader needs to be alert now. Alright, if it moves beyond the range, then the risk and opportunity both have heightened more. Alright, I hope now you're getting it. It's pretty straightforward. In order of priority, the least priority is given to the market which opens within the previous value area. The medium priority is given to the market which opens above the value area but within the range. The maximum priority for a trader is when the market opens outside the range completely. That has maximum risk also, but then as traders we need to accept that. Okay. So see, what happens here is the price opens within the previous value area, but there are no multiple TPOs that build around the previous value area, and the price just zooms out of the previous value area. And in this particular case, it moves above the range also. So these are the kind of markets you need to trade in, or the profiles you need to bet on. All right. Okay, so we come to the next opening. In this particular type of opening, we open outside the previous value area but within the range, and this is acceptance. Now this is much similar to the first acceptance case. Usually what happens is, because the market opens outside value area, it is slightly imbalanced, hence opportunity and risk is there. In this also, the overlapping happens on either side and the range is similar to the previous profile, more or less similar. So, but since the opening happens outside the value area but it is still contained within the range, Now whenever a range is defined, be it the previous profile also, that means there will be sellers and buyers present on both sides. So ideally, if you gap up above the range or gap down below the range, then the opportunity increases. And for those who have been in the market, let's say even for 2-3 months, they might know why this is, because once it happens on the screen and once you realize it, then you come to know that something different is happening. And now that you're reading these concepts, I'm sure you can look at the market much differently from now on. Alright, so see what happens here is the market opens outside the value area, previous value area here, O. It rotates, forms a value area here, the current value area, but then later on it overlaps on the downside. If you see, the range is almost similar to this profile, although this is slightly longer, but this is give or take, you need to accept this. Alright, this kind of profile again is difficult to trade, because had there been a clear selling tail here, then you could have linked it with this selling tail and known that aggressive sellers are present, and then you could have bet that the market is going to come down and overlap with the previous profile here. But since in this particular profile there was no selling tail, so that is why it was a little bit difficult. Actually, in real time, it would have been difficult to trade this on the downside, especially if we were in bullish markets. Why? Because if you see, the value area has moved up. The current value area has moved up with relation to the previous value area. So no matter that the price have come down within the previous profile, but you cannot ignore the fact that a maximum amount of trading has happened above the previous value area, which is in itself is a bullish sign. Alright, these integration aspects I will see later, but I'm just giving a insight into how you can link up things. Okay, yeah. Now the second part of this is the rejection part, that is we open outside the value area but within the range. Alright, so in this kind of market, what happens is, as soon as we open outside the value area, the rejection happens. Market does not take does not accept that level, and hence it shoots out of the range, and that is when the opportunity for the trader increases. And these are kind of markets we want to trade. Look, if you see, the price opened outside the value area but within the range. This is the M TPO, and it almost overlapped here, and suddenly market in the first 30 minutes only, it rejects this range and it shoots out. Okay, and we get a buying tail here. Although it's the first TPO, it's alright, and the market continues to move up. So as soon as the range of the day is disturbed, if it is disturbed much early on, then it is a much more stronger kind of indication. Alright, most of the trend days, if you see, which happen in the market, it does not happen in a way that the market starts moving after 1:30 or 2:30. Right from the opening bell on the day that market is going to trade up, it just starts moving up. Okay, so this is where these concepts are helpful. Okay, so next the last opening is when the market opens outside the range and it is accepted. Now these kind of openings are they reflect the most imbalance in the market, and this is the kind of opening that traders should love. What happens is we gap up above the previous day range and we just continue to rally up. This is acceptance, and since we have this kind of situation, the opportunity for a trader in terms of risk and reward both is very high. Okay, so see what happens here. The market opens, it gaps up above the previous range and it just shoots off above. You do get buying instances, even if you see in G period the prices have rotated here, but usually the first time frame, the first TPO's low will hold. Okay, this is a clue. So let's say you get an opportunity and you get a G rotation here. What you can do is you can just place a stop loss below this and trade. The risk reward is amazing. You're getting it? Yeah. Okay, the second case of the open outside the range is rejection. Now these are the kind of profiles which typically happen in bear markets, because what happens, the market gaps up above the range, it sucks in a lot of buyers, and suddenly the rejection happens, and it starts to drift down. This will be similar to the this opening, these kind of opening, you know, you will have the open rejection reverse concept that we discussed in the previous tutorial. Alright, so what happens here is that the market opens outside the range, hence it is extremely imbalanced, and then what happens is that market suddenly reverses and goes back into the previous range. Now this will happen when volatility is high, the market is in a bearish phase, but it has had a good run on the upside, that is a good retracement. Such kind of profiles play out then. So yeah, let us see. So see what happens is here the market gaps up, it enters the previous day range, then again in B period it starts moving up. Remember, the first hint that you'll get is that the low of A TPO should not be breached, but here in the C interval it gets breached. That is when you should know, combined with the fact that you are in a high volatility zone plus in a sort of bearish market, you should know that this kind of rejection will happen, and it's a huge opportunity if you trade this profile. Again, the risk reward is amazing. If you see a C extension happening, then what you can do is just keep a stop loss either on the previous day high or the current day high and be short. And for those who are trading positional, the profile high, the previous profile high and the current profile high can be used. Again, we'll come back later to that concept. Alright, so what you need, again, how the essence of this topic was again confidence. Measuring the confidence of the OTF trader is the most important thing in trading, at least for retail traders. And when market is opening outside the previous value area, you know OTF trader is present. When market is opening well outside the range of the previous day, you know the OTF trader is present and is very aggressive. So that is something you should use. But when the market is opening within the previous value area and the range, you know the OTF trader is not present. Even if he's present, he's not confident, his conviction level is low. You don't want to be in those kind of profiles. Are you getting? So again, what we have covered today about the opening and the value area, what we covered in the previous tutorials about the opening types, where we were seeing the open drive, open test drive, open rejection reverse, and what we were seeing before that, the profile structures. All of these are interlinked, and by now I hope you are trying to visualize something. I don't expect everything, but something, you know. Tomorrow if the market opens, just try and see where it is opening, whether it is outside the range or within the range, whether OTF traders are present, what are the volatility levels, what kind of beta instrument are you trading. Even though we haven't talked about volatility and beta in depth, but that will happen much later on. But still start experimenting on your own. The more you experiment, the more number of profiles you see, the more better you'll get. Okay, and whatever profiles you're seeing, see the volatility levels currently with it. That volatility is key for traders, and market profile or any other technique, if you're studying, if you don't take into account volatility, you will miss out many times. Because see, in my mental map, if the volatility is high, I know which kind of profiles will play out. If the volatility is low, I know which number of profiles will play out with a greater degree of certainty. It is not that profiles are not spread across volatility levels, they are, but sometimes you know that in uncertain markets or certain markets, what kind of profiles will play out, what kind of openings happen. So these concepts, you know, they are absolutely unbeatable when it comes to knowing what the market is doing currently, and then later on you can bring in your system and link it with it. That is a completely different thing altogether. Alright, so just research on your own, see how it's going, and I'll see you guys in the next tutorial. See you.